Okay, good morning, everybody. Okay, today I'll start off with the updates on DBS. Okay, as you can see here, the net interest income is the best for DBS as compared to peers, and the net interest margins has been surprisingly good. We believe that's because they could actually control the cost of funds, and we believe their extensive network, a well-entrenched network, will allow them to actually capture the current account and savings account and actually to manage their cost very well. And the NPL ratios have been stable at about 0.9. We feel that the management is a bit more sanguine about the NPL formations. And later on, I will just describe a little bit about our assumptions in our model, just to price in to price in a situation that is a little bit more severe, just to stress test a little bit, and then of course from there we derive our forecast for FY16. And okay, so here is basically the exposures to the assets. So the Chinese banks exposure for them is it's actually 37 billion, which is a whole lump sum. They didn't elaborate further as to whether or not how much is it is to Chinese banks and how much is it to non-bank exposure. But generally, what has happened is that the trade loans have come off quite a fair bit, and that is because of the market has not been doing very well. I mean, the trading volumes have come off quite a lot. So the trade loans to Greater China now stands at about 21 billion. And it has come off from 36 billion in June 2014. So as much as this segment has come off, they do not foresee a lot of NPLs coming up or deterioration in quality. However, they are more concerned about the RMB devaluation, and what they have not considered in their budget is 10 to 20% deterioration of the RMB against USD. And for the oil and gas offshore exposure, the NPL stands at 1.3%. The management is still very optimistic about how they manage the portfolio going ahead in FY16, and they have stress test the portfolio at US $20 per barrel, and they foresee that if it maintains at that price, then the 200 million provisions will be added in FY17 and 18. So our model, we front-loaded NPL formation from 0.9 to 1.3%. So this is when we do this, is to look at how the income will be affected, and from there we look at what's the book value, and then we assign our forecast. So what are the assumptions? The NPL formation that we assume reflect the deterioration of the Greater China loans, the commodity, and some from building and construction. But what we have not factored in is deterioration in the housing loans. We believe that the housing market will be stable, and then policies will be favorable to the housing market. And here's the target price that we have assigned to DBS for FY16. Okay, that's all for my presentation. So if any questions, you can write it here.
Good morning, everyone. This is Lin Xin. So today I will provide an update on Siong as well as Raffles. So without further ado, let's start on Raffles. So for Raffles, results is generally in line with our expectation, and the surprise actually comes for the bottom side actually comes from the contribution of the newly acquired 10 clinics under the international SOS, or in short MCH. So for the top line, we actually seen growth in both healthcare services as well as hospital services. And for healthcare services, is boosted by the new acquisition of ISOS MCH and the expanded Raffles Med clinic network, in particularly in the JB in Japan. And they have opened one clinic in Riverview last year. As for their hospital services, we continue to see growth in volume, and there's also some price adjustment due to inflation. And also the price is actually benchmarked against the public sector, so it won't go too much far off. And they have actually announced a total dividend of 6 cents last year. That's about 49% payout as compared to the the 5.5 cents last year. So just to touch a bit more on the MCH, where it has boosted the healthcare services segment. So the management shared that this MCH is actually an accretive acquisition, where it contributed about 2.5 percentage point of the top line growth. That's about a quarter, less than almost reaching a quarter of the top line growth, although that it has only been incorporated for the last quarter. So for this year, we should be able to see a boost coming from MCH, being that it will be contributing a full year contribution. So after the acquisition is just the very first stage, and they are saying that the challenge comes from integrating this MCH into their Raffles Med brand. So they've also shared that MCH staff cost is actually slightly higher compared to the average staff cost of Raffles Med, that being about 60% of the revenue of MCH as compared to 50% of the average of Raffles Med's revenue. So they aim to gradually manage downwards of MCH staff costs. They are going to do a consolidation in the staff as well as key management in MCH side. So this should be able to increase productivity as well as improve their EBITDA margin. They have also shared that MCH actually specializes in primary as well as secondary healthcare, more on the primary healthcare side, meaning the GP. So this should be able to bond well with the group, since the group offers tertiary healthcare services, meaning the hospitals. So for that 10 clinics that they've acquired, they should be able to refer to the hospitals in Singapore and soon in Shanghai. So just to touch a bit on the progress of their capex. So firstly on Raffles Holland B. So Raffles Holland B is actually up for TOP inspection this month, and should be ready to commence business in the second quarter this year. As for the Raffles Hospital extension as well as the Shanghai New Bund International Hospital projects, they are also on track and should be complete as planned. That is in next year as well as 2018 respectively. And they shared that for the Shanghai hospital site, it's very important for them to time the opening of this new hospital, it should be able to match the policy, the development in Shanghai as well. So as Chinese economy bounce back or recover from their slowdown, the recent slowdown in 2018, it should be able to gain some traction in their hospitals. So timing is one important factor. And excluding this Shanghai Newban International Hospital projects, which they intend to fund about 70% using highly likely using onshore bonds. So excluding the Shanghai side, so accounting for only the Raffles Holland V as well as the hospital extension, the remaining capex will amount to about 180 million, and this should be spread across the next 18 months and should be funded internally. And we also see an additional member to Raffles Med network of clinics. There's a multidisciplinary center opened in Waterpoint in last month. And I believe that you are who are following Raffles Med closely are aware that they have actually proposed a 1-to-3 share split, meaning that for one share it will be equally split to 3 shares. This is to enhance affordability as well as accessibility to both existing and potential investors. Although that now that we have a smaller bond lot that investors can be purchasing at 100 units, but apparently according to the management, they are saying that there are still a lot of investors and prospective investors are actually asking the management to split the shares such that it would be more affordable for them. And hence they have come to a conclusion, and currently we are waiting for SGX approval. With that, we actually reaffirm our buy rating with a slightly higher target price at about $4.88. So upon completion of this share split, it should be equivalent to a target price of $1.60. Moving on to Sheng. So for Sheng, Sheng's results is also generally in line with our expectation. The only surprise that comes in would be coming from the high other income and as well as the net tax refunds. So for the higher other incomes, it actually arising from the higher government grant, where they have introduced the self checkout machines. So coming from that side, we are seeing a higher other income. As for to wrap up on the whole retail outlook in FY 2015 for Sheng. So for Sheng side, we can see that economy actually slowed down, and haze has actually had a negative impact on Sheng's demand. And management also shared that stronger Sing dollar against the Southeast Asian currency actually helps to lower input prices, but it also lowered foreigners' spending, in particular in the Woodlands outlet. We have also seen that the SG50 celebration, it actually contributed to higher volume, but it also induced intensive aggressive competition among NTUC as well as Giant. So for the regulatory changes on alcohol sales, they have also shared that it has caused a structural change in certain stores. In particular, those are nearer to those dormitory like the Penjuru side, and so these these regulatory changes is not has actually caused a structural shift rather than a temporal effect. So just to update on the expansion plan or the new retail areas that's coming in the pipeline in the next coming 2 years. So we'll be seeing an additional 31k square feet retail space. That would include also the two renovation sites coming from Tampines and the Loyang Point site. So for Yishun Junction 9, it should be completed at second quarter of second quarter of this year. This is actually 1 year earlier than expectation that the management has actually guided us earlier. So they have also shared that they are going to use 10.5k square feet for supermarket operations, and the remaining is they are requesting for it to be leased out for non-supermarket operation. So this part is still pending for approval. As for Tampines and Loyang Point, it should be closed in fourth quarter of this year as well as second quarter of this year respectively, but it will be reopened in next year in the first quarter. So both of these would actually they would be shifting to after renovation they will be shifting to a larger space. As for Circuit Road, they've recently a winner of the bidding for Circuit Road shop. So they are currently waiting for HDB to grant and execute the lease. So this is actually a small shop at about 3.5k square feet. So given that these two will be closed at the second half of this year, these two stores, according to the management, it contributes about 4.6% to the top line. So probably in giving a half year discount, so it might have about 2.5% impact to the top line this year. So without these two contribution, the management would focus to nurture new stores, and we have 6 new stores in 2000 opened in 2014 and 2015. So these are the 6 new stores that they are going to nurture and bring it to mature stores stage. And on the other hand, they are also going to rejuvenate those sluggish underperforming to 2012 old stores. So although that it involves some capex, but it provides long tail benefits because renovated stores tends to behave like new stores. So it will give about a 5% growth for same store sales. So some of the notes that we have taken from the briefing itself is that the management is actually cautiously optimistic on their gross margin to be improved, but that is actually vulnerable to competition pressure. So as if you are familiar with Siong, they're actually targeting a 25% gross profit margin. So they actually hit that target at the fourth quarter last year. But in the overall of 2015, we are seeing it at 24.7%, which is also an 0.5 percentage point improvement from last 2014. Yeah, so this is actually coming from their margin enhancement initiatives as well as their improvement in product mix. Although that we are seeing that it actually only improved by a shift of 1 percentage point, and there are a lot get to be filled before reaching the ideal 50-50 ratio of grocery to fresh products ratio. So this ratio is the ideal ratio where they have the optimum margin product mix. Yeah, so they are still working on it. and to sell more fresh products. And for capex wise, they are still remain at zero debt, and their healthy cash flow with a positive operating cash flow generation should be able to provide sufficient room for them to maneuver and to internally fund their capex. And we are also of the view that the 90% dividend payout ratio is sustainable. So with this, we actually reaffirm our accumulate rating with a slightly higher target price at 0.97% based on our higher estimated E- FY16 EPS at 420 cents, but with a lower PR ratio. We adjusted lower to reflect the shift of 3-year average historical PR. Previously, we have adopted a 25 times PR ratio. So yeah, this is just a chart to illustrate the 3-year average P. So with that, I have come to the end of our presentation. Now we'll open the floor to questions.
Hi guys, I'm Jeremy, the technical analyst over here. There was a question asking about the SDI outlook over the next 6 to 9 months. So I can briefly go through with you guys the technical outlook of where I see SDI will be heading in the 6 to 9 months period. So as you can see, this chart over here is the SDI. and it's based on the daily time frame. So the downtrend is very obvious over here, and as you can see, we actually are experiencing some kind of a retracement for the past 2 to 3 weeks. So I'm actually expecting SDI to have some short-term rally back up to probably around the 2698 area to 2740 area, which happens to coincide with a 38.2% Fibonacci retracement level. And thereafter, I expect price to continue with the downtrend. And the long-term view is for price to continue to head lower. As you can see over here, the downtrend is very strong. And hold on a second, I get rid of this. What is holding price up now is this strong support over here back in 2011. Once this support gets broken, which is around 25, hold on a second, which is around 2521 area, we should see huge sell-off coming into the market, where the next support could be found somewhere around 2424 area. But the long-term picture for SDI definitely doesn't look that bullish. To me, I remain bearish for the long term, and yeah, that's where I see it happening for the next 6 to 9 months.
Hi, this is Lindsay. There's a questions on management comments on the report regarding both the Jurong Super Bowl supermarket as well as the Verge supermarket leases. So for the Jurong Super Bowl lease, yes, it's actually been price tagged to sell, but at the moment, the owner has yet to find a buyer for it. So I'm guessing the management shared that if it's not sold and the lease ended, there are it's highly likely that they are going to continue their business there. So as for the Tekka Mall side, the Verge, in other words, so there will be some redevelopment going on there, and but however they have not heard anything regarding the plans for redevelopment yet. It's not finalized yet, so at the moment they don't have any particular plans or schedules regarding the development for Virtual site. So we will be updating you guys uh, as soon as we have updates on it.
Okay, we have two questions on banks. The first one is 60 cents dividend per share for DBS sustainable in this environment. Okay, I think for the banks the payout ratio is lower, so it's sustainable. But I think the question, but I mean for me personally, it's not the question of sustainability, but the question of how much the banks will want to retain the earnings to fulfill the requirements for the Basel. The problem is that the Basel III requirements are not finalized, and they have to prepare themselves for any further updates. Of course, now the banks the CET Tier 1 ratio is well above the Basel III requirement of 6%. But I think generally the banks would want to put it at about 11 to 13% CET Tier 1 ratio for the sake of a reputation. See, and this is the kind of premium that they can earn on the market for having a very good reputation. So we are quite surprised that DBS actually came out with 30 cents, 60 cents in total, which is above the 58 cents. Okay, so which is above the 58 cents, and we felt that maybe I mean, from how the management has um, elaborated on the market outlook, they feel that it is okay. So probably this 60 cents is to give some confidence to the market. So the thing is that if, let's say, for example, if the market becomes more positive, they may revert to 58 cents. But generally, I think this is uh, quite a nice dividend per share payout. But if you are expecting it to increase and all that, we are less optimistic on that because, like I said, they would like to retain a lot more earnings for calculation for the Basel III requirements. And we have a second question, which is all three banks highlighted. Which one appears to provide the highest potential returns, dividend yield target price? Okay, our model for UOB is not out, but for OCBC and DBS is out, and we have a higher return potential for DBS, and that's because it has underperformed amongst its peers. And we feel that most important thing is the moving forward, considering the headwinds in this in the markets here, the regional economy, as we already know that the emerging markets have reversed their potential growth. They seem to be growing much lesser, and so considering those, I mean, all segments of the loan books are facing headwinds. So we are very cautious about that, and we feel that the premium associated to the book value should be discounted instead. So it should be a slight discount to book value moving ahead. I mean, the premium would not be as great as maybe 1.2 times price to book. So at considering those, if it trend along those lines, it should be quite okay. But we are not looking at outsized valuations. Thank you very much. Okay, since there's no more questions, we'd like to thank you for attending this webinar. Yeah, see you again next week. Thanks. Bye.